Hey there, fellow traders and investors. Welcome back to our YouTube channel. In today's video we'll be discussing the importance of multi-timeframe analysis. In forex trading, having a solid analysis strategy is key. And that's where multi-timeframe analysis comes into play. Instead of solely focusing on one time frame, whether it's the 5-minute chart or the daily chart, multi-timeframe analysis involves examining price action across multiple timeframes simultaneously. By incorporating different timeframes into your analysis, you gain a more comprehensive understanding of the market's overall trend and direction. In this video, we'll walk you through the benefits of multi-timeframe analysis, how to implement it effectively into your trading strategy, and share some practical tips to help you maximize your profits. Don't forget to smash that like button and subscribe to our channel for more valuable insights and strategies. Also hit the bell icon to turn on notifications, so you never miss out on any of our future videos. I'll see you after the intro. First and foremost, multi-timeframe analysis provides us with a broader perspective of the market. Instead of being fixated on one specific timeframe, we're able to see the bigger picture by analyzing multiple timeframes simultaneously. This allows us to better understand the overall trend and direction of the market, which is essential for making informed trading decisions. Now, let's take a closer look at a real-life price chart example to illustrate the power of multi-timeframe analysis. Here we have a price chart showing a clear downtrend, characterized by a series of lower lows and lower highs. In a downtrend, we're typically looking for selling opportunities, right? As the market keeps breaking previous lows and respecting our supply zones, it presents us with ideal conditions to look for selling opportunities. The market broke below a previous low and came back to retest this supply zone, which seemed like the perfect setup for a sell position. You enter your sell order with a take profit set below the previous low. However, just a few minutes after placing your sell order, the market breaks above, completely violating your supply zone. Now you're left wondering what went wrong, especially since you applied everything you've learned correctly. The reason you got it wrong is because you were solely focused on one time frame. But when we shift our focus to a higher time frame, we can see that the market actually broke above a previous high, indicating a change in character and a potential trend reversal. We now have a clear demand zone at the extreme, where the market might potentially retrace before continuing with its bullish sentiment. Meaning what seemed like a downtrend earlier is actually just a retracement back to our demand zone before price continues in an upward trend. The reason why you lost this trade earlier is because price retraced back to our higher timeframe demand zone, where a lot of people will be looking for buying opportunities since they understand the overall market sentiment. While only a few people placed sell orders at this supply zone, that was indicated by the small rejection before price suddenly broke above and continued with its bullish sentiment. This example underscores the critical importance of multi-timeframe analysis. By considering various timeframes, we gain insights into the broader market sentiment and trends. It's not just about identifying individual setups, it's about understanding the context in which those setups occur. When we view the market in a higher timeframe, such as the daily timeframe, we often see a clear uptrend with distinct impulsive movements and pullbacks. But viewing the same chart on a smaller time frame, such as the 15-minute or 30-minute chart, we might perceive these pullbacks as countertrends with clear lower highs and lower lows. So, when you only look at one time frame, you might mistakenly interpret these smaller fluctuations as long-term trends rather than short-term retracements back to our demand zone before price continues pushing up. So, how do we effectively utilize multi-timeframe analysis? Step 1. We start by analyzing the higher time frame, such as the daily chart, to identify the overall market direction and key higher time frame demand zones which can potentially fuel the market's upward momentum. From here the market is most likely to retrace back to the demand zone before it can continue pushing to the upside. Step 2. We move to a middle time frame, like the 4-hour or 1-hour chart, where we anticipate a retracement to our higher time frame demand level before price continues its upward trajectory. However, instead of waiting for price to reach our demand zone, we can also look for signs of a short-term trend reversal and identify supply zones where we can capitalize on short-term selling opportunities until the market reaches our higher timeframe demand zone. Step 3. Once the market reaches our demand zone, indicating the end of the short-term downtrend, we transition to a much lower time frame, like the 15-minute or 30-minute chart. Here, we wait for a change of character, signaling a trend reversal. Then we identify our lower time frame demand zone and wait for the market to interact with it. We then place our buy orders with a stop loss below the lower timeframe demand and a take profit above the higher timeframe previous high. Then we let the market play out. This is the reason why multi-timeframe analysis is crucial as a trader, because it offers a comprehensive view of market dynamics. One of the greatest strengths of top-down analysis is its versatility. It can be applied to various trading styles, catering to different types of traders in the market. Whether you're a day trader, swing trader, or even a long-term investor, the principles of top-down analysis remain the same. The market structure that occurs on a higher timeframe can also reoccur on a lower timeframe, making top-down analysis applicable across the board. For swing traders, for example, you can start analyzing from the weekly timeframe all the way down to the 1-hour timeframe. This allows you to capture medium-term trends while maximizing profit potential. And if you're a day trader looking to capitalize on long-term price movements, you can still utilize top-down analysis by starting from the daily timeframe and drilling down to the 15-minute or 30-minute timeframe. For scalpers who thrive on quick trades, they can start by establishing the directional bias on the 4-hour timeframe and then drill down all the way to the 5-minute timeframe. This enables them to identify short-term price fluctuations and execute rapid trades based on the overall market sentiment. Let's apply top-down analysis to analyze to this specific currency pair, starting from the daily timeframe down to the lower timeframes. Beginning with the daily timeframe, we observe a clear upward trend characterized by consistent breaks of market structures. However, recently, price broke below a previous low, indicating a significant shift in market sentiment and potentially signaling a trend reversal. In response to this change, we mark out our higher timeframe supply zone where we anticipate the market to retest before potentially continuing downwards in its new trend. Transitioning to the 4-hour timeframe, here, we wait for the market to take out this high, creating a change in market character and signaling the start of a short-term price reversal back to our supply zone. In this particular price chart example, we encounter a challenge. Price leaves behind multiple demand zones that it never comes back to retest, meaning we couldn't capitalize on these short-term buy positions before price retraced to our higher timeframe supply zone. Nevertheless, now that price has reached our supply zone, we must switch to a much smaller timeframe to observe how price reacts to this level before considering any potential trades. Before we start looking for selling opportunities on the hourly timeframe, it's crucial to wait for price to break below the previous low, confirming a trend reversal. The market plays out, and finally, we see the break below the previous low. This confirms the trend reversal we've been anticipating. From here, we identify supply zones where we anticipate the market to retest before potentially continuing downwards. With our supply zones identified, we now place our long-term sell orders, setting stop-loss orders above the supply zone to manage risk and take profit orders all the way down to maximize profit potential. As price continued to push downwards, we found ourselves in deep profit. During this process, price broke below the previous low, leaving behind yet another supply zone, a clear indication of the market's bearish sentiment. After patiently waiting for the market to retest our newly identified supply zone, we seized the opportunity to place our second sell order, setting our stop loss above the supply zone and take profit orders to capture profits all the way down. Over time, the market played out according to our analysis, and we were able to capitalize on these two trades, securing significant profits along the way. By meticulously analyzing the market from the daily timeframe all the way down to the 1-hour timeframe, we positioned ourselves strategically to navigate the markets with confidence. Let's apply the same concept to our second price chart example. Starting from the daily timeframe, we observe a clear uptrend characterized by breaks of structure and new highs. Price is still trading above a crucial swing low, indicating that we are still in an uptrend and on the lookout for buying opportunities. We mark out our higher timeframe demand zone where we anticipate price to react positively and continue its upward movement, maintaining the overall bullish sentiment. We need to switch to a smaller timeframe to observe how price reacts to this level before considering any buy orders. Transitioning into the 4-hour timeframe, we begin by refining our demand zone to better fit the current price action. While it's evident that price is showing some rejection towards this level, before placing any trades, we need to identify a change in market character. However, there isn't much clarity from this timeframe, prompting us to switch to an even smaller timeframe like the 1-hour or 30-minute timeframe. On the 30-minute timeframe, we finally spot a change in market character, indicating a potential buying opportunity. We identify lower timeframe demand zones where we can potentially enter buy orders. After patiently waiting, price retraces and retests our demand zone, providing us with the opportunity to execute buy orders. We set our stop-loss orders below the demand zone and take profit orders all the way up to our higher timeframe high, maximizing our profit potential while managing risk effectively. Zooming out, we observe that price pushed all the way up and broke above the previous high, reaching our take profit target. This confirms the validity of our analysis and the effectiveness of our trading strategy. There you have it, traders. I hope you've seen why multi-timeframe analysis is crucial for making informed decisions in the market. In this video, we've learned that multi-timeframe analysis helps us differentiate between the long-term trend and short-term fluctuations. It guides us in knowing when to look for short-term positions and when to focus on long-term opportunities. Moreover, it helps us avoid unnecessary losses by waiting for confirmation on the lower timeframes before entering trades. By entering trades only in alignment with lower timeframe zones, we reduce our stop-loss size and effectively manage risk. Most importantly, multi-timeframe analysis helps us avoid going against the current market momentum. By waiting for a change in market character, confirming the start of a new trend, we ensure that we're trading in harmony with the market's direction. I hope the insights gained from this video will enhance your trading journey. Don't forget to like and subscribe to the channel to help us grow and continue producing insightful content like this.